The world in 2022, intensifying political acrimony, the highest inflation in more than 30 years. COVID-19 still raging throughout the planet. And the stock market? It's not exactly predictable either. There wasn't even a 10% correction in 2021, yet market participants expressed the highest level of anxiety in years. What do you do when everywhere you turn, the corporate media is shouting market turmoil and encouraging fear? Where do you turn for honest answers and insights? Right here. CB3 Live. We exist to deliver accurate, sensible, and well-sourced educational insights on the world markets, global health updates, and the U.S. economic data that can and will affect your financial future. At CB3 Financial, we don't just manage your assets, we become one of them. Welcome to this month's CB3 Live. Good evening, everyone. Live from Nashville. It's Thursday, July 14th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We're really glad you joined us. It's hot here. I bet it's hot where you are. It's the middle of the summer. That's what we have to expect. Do we have the summertime blues? Maybe some of you do. I saw a few notes in the chat that you're expecting and wanting to see better times, and I think you're going to see that. I think you're going to see that later this year. It may not be in this quarter, but by the fourth quarter. And I am predicting market highs in January. I've got other projections. If you haven't seen them on Twitter, you'll see them here in just a few minutes. For those of you that are new to the program, this is what we cover. Sometimes more time is spent in different areas. We're going to deal a whole lot with what's happened in the market, what's happening with inflation, what's happening with this recession scare. Just because you're hearing news, if you're watching the corporate media, that's not healthy for you to hear. It's not good for you. They're serving their own best interests, which is to get eyeballs on the screen, and that's not what's in your best interest. I'm going to tell you the truth tonight. I manage money for a living. I'm going to show you charts and data. I'm going to walk through them as quickly as I can, but there's a lot here to see, folks, and I want to give you information so that an hour from now, you're going to feel better and be able to sleep better and realize that this is a passing phase and we have been here before, okay? If you are new, please subscribe to us on YouTube. Check the little bell so that you get notified whenever I go live or when I post one of my inter-month updates. Follow me on Twitter, Facebook, LinkedIn. I tweet every single day, sometimes twice a day if a lot's going on. Hope that we'll see you there as well. So the monthly review, 2022 since January 4th, that was the high of the year, just 2 trading days in, and it's been straight down from there. So what does that mean? Well, the NASDAQ has had its worst half year ever. Okay, so that means it's an aberration in my book. If you look back here on the chart, you'll see 1962. Well, that's actually 63, I think. And 1970, and then here we are, 2022. The 3 worst halves, but if you're going back 20 or 60 some years, you can imagine that this has got to be an aberration. And for many reasons, I think it is. This is just my first example. So this unusual downturn is, yes, quite unusual, okay? If you follow my tweets, you saw this, or you would have seen this on June 27th. I called the market low, actually referenced it back to June 17th. I'll highlight that date going forward and why I picked that day. There are things called sentiment indicators and divergences that show me that the low has been made. I could be wrong. I understand that, and I will give a mea culpa if that is the case. But as of right now, I'm not changing my story and feel pretty confident, especially after the market action of the last 2 days. We'll get to that in just a little bit. To quote the late Jack Bogle, founder of Vanguard, okay, so pretty big guy there, the daily machinations, word of the day, machinations of the stock market are like a tale told by an idiot, full of sound and fury, but signifying nothing. I'm not sure if he was talking about the market or the market's media, but in either case, it is a true statement. You guys that have been watching the program have seen this chart. So if you're new to the program tonight, I have a lot of charts. You don't need to study every single thing on it. There are basic elements that you need to be aware of. And the basic element here is this is 100 years of stock market activity. And even if you don't know anything about the market, you can see that the lines go up. All right, the red areas are what are called secular bear markets. Those are elongated bear markets. The long black lines are secular bull markets. We are in one right now. It doesn't feel that way, but that's because we are in a cyclical bear market. Difference between secular, meaning multiple business cycles, and cyclical, meaning short term. Now, I want all of us, and I'm going to do it too, I want you to lean in on your screen because you need to see that little yellow dot at the top. Okay, so lean in. All right, everybody see that little tiny line? That is where we are. You know, the "you are here" when you go out to a state park and it says "you are here" so you don't get lost. Okay, that's where we are, that itty bitty little line. All right, in the last 100 years. Now, does this look like the world is coming to an end? No. Does it feel like it at the time? Yes. Because of what? Recency bias. Whatever we're going through recent seems like this is what it's going to be like always. Let's zoom in on this 12 years, okay? We just took that previous chart, zoomed in. You see the blue circle? That's where we are right now. Now, go back a little bit on the chart and you'll see that price point that touches the lower blue line. That is the lower bound where the market hit on March 23rd, 2020. That was the last bear market, okay? Now, you can look at this chart and even if you don't, able to see the numbers or you don't understand that much about trading, you can see that where we are is not as bad as where we were on March 23rd, 2020. All right, it just feels bad. So what we're going through right now is a test of what's called the midpoint of a channel. All right, you don't need to memorize that. But the main thing you need to do is go away from this and realize, oh, okay, we're at what the blue circle is. That's not as bad as it was in 2023. So why does it feel as bad? I'm going to tell you, okay? The media will not tell you. They're going to tell you it's as bad as 2008, the Great Depression, and it's not. This is a list of all the bear markets going all the way back to 1903. And you can see the downturns, right? The worst this market got was down 25% in the S&P 500. There are many, many bear markets here that went much lower than that in our lifetime, okay? Including 2020, all right? Now, so why does this feel so much worse? Well, pretty simple. And here it is. Look on the right side of the chart. That's the number of days it has taken for each of those previous bear markets to return to being at all-time highs, or at least pulling out of the bear market. So if you look at the bottom, you'll see 165 days, and this was actually going back to June 17th, because that's the low of the bear market, in my opinion. All right. It took me till the 27th to be able to publish it, but I believe that's the price low, June 17th. Now, look up above that one line, and you'll see from February 19th to March 23rd, 33 days. There wasn't even enough time for my clients to call me and say, oh, we're in trouble here, because it all happened so fast, because it was not a financial bear market, and it was certainly not secular, it was cyclical, and it lasted how long? 33 days. Look at that number, folks. The difference between emotionally how you feel in a downturn when something lasts 33 days versus 165 days is dramatically different. It's the difference between having a Band-Aid pulled off your arm and, running into a brick wall, okay? So that is why psychologically this feels so much worse than it did 2 years ago. These are the worst S&P 500 drops going back 20 some years. And every single one of them is worse than where we are right now. It just doesn't feel like it. Recency bias tends to cloud judgment. And the media takes advantage of this because they want you to watch their programming and watch the ads that are on their program. They're in a business. I'm not saying they're evil. I'm saying that their objective is different than mine. Mine is to educate those of you that are not clients and to support and embrace those of you who are watching that are clients. These are all worse bear markets than where we are right now. So I understand that some of you, maybe all of you, could be skeptical about the bottom being called. I've been doing this 30 years. I've never called a market bottom, but I'm going to show you a series of slides that reveals to me what is happening underneath the top level news. The top level news is that the S&P's gone down, but there are things going on underneath the market, all right, which I'm calling sentiment indicators that are not actually reflected in the price of the S&P 500. Okay. Don't try to read the little numbers on here. What I want you to see is the top line is the S&P 500 going down. The bottom line is the NASDAQ. So what you're seeing is people selling in the S&P, but in the NASDAQ, near the end of the day, they are going in and buying, especially on this last day, which was just 2 days ago. All right. We dramatically saw this happen Wednesday and then again today, where the people on Wall Street, and again, they're not bad guys. They're just in the business to work for the wealthiest of Americans. And they are really, really, really smart. I don't ever try to say I know more than Wall Street. If anything, I try to coattail them. They don't exactly publish their game plan, but that's what I'm trying to do because that's the smartest money on Wall Street, in my opinion. All right. The people that work at the major firms. So Wall Street anticipated this recession way back in December. We saw the indicators, but again, we remain fully invested because we believe this is a secular bull market, meaning long term. If you remember the chart that you guys have seen many times, if you're new to the program, the one I showed about 4 or 5 ago, those black lines going up, those are 20 to 25 years. My projection is this secular bull market began on April 10th, 2013, and will likely go into the 2030s. Into the 2030s, could well be the mid-2030s. There will be more times like this that are cyclical bear markets, and they will cause the same fear. What I'm trying to do is educate you and emotionally prepare you so that you don't sell out in these emotional times in a panic to the people on Wall Street who are just waiting for you to do that, okay? This is what happened in the discretionary sector. You guys know that I watched the program. There are 11 sectors in the S&P 500. One of them is consumer spending or consumer discretionary spending. When the market is going down and then the Wall Street players come in and buy, that date is June 17th. And you can see now, even though there are many sectors, including energy and materials and financials got hammered today. The first set of earnings from JP Morgan and Goldman Sachs, not good. And they're using that to make you think that that's what every single earning for the year is going to be. It's not, and I'll show you data on that. You guys that have watched the program know, but my next to last slide before showing performance is that earnings report. So this is an underlying sentiment indicator of one of the sectors and one of the very most important sectors turning around. Okay, again, more channels here. This is mid-cap stocks. The general market is going down, but after June, those purchasing in that area, which is an accelerated growth area, okay, not value, not conservative. Wall Street is saying, okay, it's gone down far enough. Now we're going to start buying the growth names because people are selling them to us at ridiculous prices. That's basically the distribution pattern that has happened the first 6 months of this year. Now, another way that I can tell that the bottom is in or that the concerns for inflation are minimal is the 10-year yield. You guys hear me, that you watch the program, you know that bonds, we don't trade bonds much at all because we're a stock firm. But the bonds market is a bigger market than the stock market. So those players are pretty smart, really smart. Okay, so you can see the yield dropping here, right, over the last several months. You see the price going down there. If the yield is going down, that means the price of the bonds is going up. Who in their right mind would be buying bonds if they believed that a serious inflation crunch was going to come and stay with us? Because they're losing money. If they're buying a 3 or 4% bond and inflation is at 9%, they don't want those bonds. They're going to be losing money. Not only that, they're locking in a loss. Okay, but the biggest, deepest pockets on Wall Street, according to this data, are saying, you know, we recognize what's here, but we don't think it's a long-term problem. And I trust them more than I trust the pundits on the TV, and I certainly trust them more than the panic selling that I see mostly in the mornings in the S&P 500. So sector rotation, there are 11 sectors, I just mentioned that, is critical to this notion that the 9-year secular bull market that began April 2013, I just mentioned, is resuming. That's my whole strategy. Go back about 7 slides, you remember the line moved down to the middle line and it's going to bounce off. That's what I believe. It could keep going, and if it does, then my thesis is incorrect. But if we truly are staying in a secular bull market, it will bounce off that midpoint or nearby and resume its trajectory to new lifetime highs. In the beginning of the program, I projected January of 23. The cyclical bear market will have ended if that happens, okay? The three key sectors of the 11, XLK, which is just a ticker symbol for technology, XLC, which is a ticker symbol for communication sector, that'd be the Facebooks and the other, well, Meta, obviously, Google. And then XLY, which is discretionary spending, that's going to be homes, cars, clothing, movies, etc. Those sectors have to succeed because they are such a huge part of the S&P 500. We need to see those growing. So what did I see last Friday? After a down week, these are the top performers. XLY, XLK, XLC. What are the bottom performers? Materials, energy, utilities, real estate. So those four are the conservative. Actually, XLP is considered a conservative sector as well. So if you just look at the data on the S&P 500, you're thinking, oh, it's another down week. But I'm looking at this and getting excited because I'm seeing sector rotation. Key phrase for tonight, sector rotation, okay? We want to see money rotating out of these conservative sectors into the aggressive sectors, and I've highlighted them in green. You saw it in the previous charts. This is yet another way to show you what it looks like, okay? Again, you can't see the data, but what I'm showing you here is the market going down with a red line. But look at, you see the red line on the bottom three? Those are the three sectors that I've been talking about. And they have punched through where the red line is. You see the top chart? That hasn't punched through its downtrend. The S&P is still going down. But those three sectors have punched through, punched above. And that's telling me there is significant rotation going on. Individual traders like you and I cannot do that. It takes Wall Street and billions of shares to make this happen. And when Wall Street's buying, I'm following, I'm coattailing him, as I said earlier. So another sentiment indicator that I follow. This is the NASDAQ divided by the S&P 500. So the market continues to go down and down, but look what's happening here. People are spending more investing time, and I say people, I mean Wall Street, in the NASDAQ than they are in the S&P. That's why this chart, this is a relative chart, so this isn't price. This is just saying that when the market's tanking, someone's coming in and they're not buying real estate stocks or consumer staples or utilities. They are buying growth stocks because there is a collective that believes the low is in. Same thing here with, these are two exchange traded funds, IWF, IWD. So this is growth versus value. If Wall Street thought that we had another 15 or 20% to go to the downside, they would not be buying growth stocks. They would be buying value stocks. They would be buying Procter & Gamble and a bunch of utilities and things that don't move but pay big dividends. They're not doing that. Growth stocks, much of the time, do not pay dividends. This is movement that's been happening since the end of May. And what told me on June 17th, when that low happened, you can see on the chart, we're moving up there and it pulled back just a little bit, but then it went right on back up. Okay, so this is exciting to me. This is stuff that you're not going to hear on the news because they don't want you to feel good because you won't watch them. All right? There's always a contingency at Wall Street that's thinking 3 moves ahead, 6 moves ahead. That was the best visual I could find. A really grand master is thinking 5 or 6 moves ahead, way beyond my skill set. All right? And these folks on Wall Street are seeing these sentiment indicators before I saw them and realizing, yeah, panic's done. So that's one reason why Wall Street was using Wednesday's, yesterday, and today's news to scare traders out of aggressive growth stocks that they might have been in a long time or that they might have bought in March or April thinking this has to be the bottom, and it wasn't. Wall Street firms were buying these like crazy end of day, and I'm going to show you in just a couple slides here how I know when the time frame is, okay? Despite all this news, fear is subsiding. The absolute worst news for the bears that we believe, they think we're going to be in 1929, 74, 2008. There's no chance. There's no chance of that. Not at this particular time and with the data that I have. Okay? So this is the chart I just mentioned. I believe the conclusion here, and I want to thank Tom Boley. A lot of this data is his. You guys have seen him. I interviewed him on my program. Just a brilliant market wizard. He doesn't advise for clients. He advises for people like myself. And he's just really helpful. So here's what he has seen in the data he provided here. So Wall Street is allowing these emotional traders to panic out, like I mentioned. And why do I and he see that this is happening in the morning? Let's look at, on the left-hand side, you'll see the dates. So that's April 21st to May 20th, May 23rd to June 6th, etc. The opening gap, the market opens at 8:30 Central Time, 9:30 if you guys are in the East or wherever you are. And we're looking at the downturn there, okay? And then the next column is going to 10 a.m. And again, these are all Eastern times. 10 a.m. to 11, 11 to 2. You see the green coming on the screen? Look at the totals at the bottom, okay? What this means is the market's gapping down in the morning, letting the weak hands get out, let them sell their shares, and then Wall Street waits. You can see from 11 a.m. to 2 p.m. there's hardly anything happening, 0.39 negative, and then 41.64 a move to the upside. All right, so this tells me Wall Street knows what's going on, okay? So during the day-to-day or even hour-to-hour action, it's difficult to see how much of this is happening. It takes years of watching this, okay? And again, nobody in the news wants you to know about this. All right, so of the 6 key industry groups, 5 of them bottomed on a relative basis before the S&P bottomed. And those are the charts that I showed you. Does that guarantee that the bottom is in? It does not. But what it tells me is Wall Street believes the bottom is in. Could Wall Street be wrong? Absolutely. They were blindsided with COVID now, weren't they? Okay, that was a humongous move in just 3 weeks. 34% down, all right? So Wall Street can get surprised, but I don't think they're surprised here, okay? All right, another indicator. No, there's a lot of numbers on the screen. The reason we invest in growth, if you look over this time frame of 10 years, you can see the huge downturn. That's the 2020 crash, or if you want to call it that, during COVID. And then this pullback now. Again, you can see the pullback now is not nearly as bad as what we had in 2020. And I've already said earlier, why is that? Why does it feel so bad? Because of the length of time it takes to recover. 66 days, I think it was, versus 33. But the reason we invest in growth, look at the green NASDAQ. If you can read the number, I'll read it for you. During this time frame, up 162%, S&P up 95. The S&P is more of a value place for stocks, okay? The real aggressive growth stocks are in the NASDAQ. And the aggressive sectors, look at XLC, XLK, XLY, up 171%, 144, 133, versus the value stocks up 76. Now, you might say 76 is a good number and you're happy with that. Well, if that's the case, then we're going to talk asset allocation, and maybe GI is where you need to be instead of CG or SG. We'll get to that, a little bit later in the program here. But this is where the growth is in America. If you want to know the pulse of America and what's growing and what new technology is being developed, you're not looking in the S&P. You're looking in the NASDAQ. So we've experienced this brutal 6.5-month period. I think the S&P has discounted a lot of bad stuff at the current price. I really do. Be careful believing that it must continue to go lower just because the news is bad. And why do I say that? Because the market bottoms before the news turns positive. Always, always, always. And when we do bottom, the next year historically has been very bullish. So this is, I think, the 7th instance I'm giving you of why I called the market on the 27th, which again was 10 days later than Tom Boley called it, all right? The best one-year return, 2020, and those of you that were in CG, we didn't get that whole 78, but we got 63.5% of it. The average one-year return after the bottom of a cyclical bear market is 42.5, we'll call it 43%. You do not want to be on the sidelines when that happens, okay? And if I'm right about the bottom happening on the 17th, what does that mean a year from now, okay? If the S&P rises just the worst one-year return, which is what, 1993, I think, that puts the S&P up 29.5. I just mentioned that. If it picks the average, that means the S&P from now until a year from now, or technically June 17th, 42.5%. If 2020 repeats itself, and I think it could, because we're still pulling out. I mean, I'm still hearing COVID news. There's no COVID section tonight because I just refuse to keep covering it. All right. Somewhere between 29, 42, 78. That's a pretty big range. But you don't want to be out of that. You just don't. Well, I don't want to be. It's up to you whether you want to be. But I'm trying to give you the data, to give you the emotional fortitude to stick with it, okay? I've shown you this before, but this is updated. The extreme fear, this is actually CNN Business, believe it or not, that monitors by surveying people, are you scared? Are you fearful? Warren Buffett has always said you need to buy when there's blood in the streets, meaning extreme fear, and you need to sell when the cabbies are quitting their jobs and becoming day traders. We don't have a fear of that right now, but there's still plenty of fear. And then there's a flight to safety, meaning bonds, and that is down near a 2-year low. So I can't explain why the fear is there. I don't like seeing my accounts low, just like you don't seeing yours low. But you need to know that we are looking for the data that will give us some kind of indication when this bottom is going to be. I think I've shown it to you. I hope this gives you the confidence to know that things are going to be fine. Okay? The stock market always bottoms before the news turns positive. If you're waiting for the news to turn positive, it's not going to happen. If you're waiting and then you want to get back in, you'll miss 18 to 20% of the move in the S&P. Look back at 2008 and then look at the news articles. March 9, 2009 was the low of the 2009, the last really, really bad market, 670, 653 in the S&P 500. And you weren't seeing positive news till June. All right. So don't make that mistake. And market timing can be costly. You guys that have watched the show have seen this. If you stay fully invested, this is basically a 31-year, report here. You can average about 10% a year, not too bad. You miss the best day during that time frame, one day. Now your annualized return is only 6%. You miss the 2 best days, it's 3%. You miss the 3 best days, it's break even, and then it's negative after that, okay? We stay fully invested when we believe there is a secular bull market in place. Your accounts, if your clients are fully invested. We rotate stocks. We rotate sectors because of the information that I've presented in the program tonight and previous videos. If you're new, go back and watch my previous shows. We're following Wall Street's money and putting you in it to try to give you the very best possible risk-adjusted returns that we can. Okay, so I mentioned that we had 2 banks that disappointed today. And of course, Wall Street now wants to say it's going to be an awful earnings, okay? Those of you that have watched the program know this chart. This shows the reporting of each of the stocks in the S&P 500. So 73% is usually where it comes in. We've beaten that really for the last 5 quarters. We're at 89%. I realize there's an asterisk by that because it's only 18 stocks, all right? There'll be more by next month, a lot more. But 89% does not sound like a crisis to me. 100% of the financials beat their projections. Industrials, 100%. 100% of technology. That 100% financials does not reflect the 2 this morning that blew it, okay? JPM and Goldman Sachs. But still, it's a good data. So for you clients, and I'll pause here to take questions. This is how we are doing 3 years, 5 years. Strategic Coast still beating over a 3-year time frame. Sorry, the S&P 500. Growth and income I've highlighted in green because, and this is what I meant about asset allocation earlier. If you are with us and you're in solely our aggressive programs and you're just feeling the sweat and really don't want to go through this again, we need to talk about moving some of that money into GI, which is growth and income. I don't hear from my GI clients, okay, that are primarily in GI, that have a lower risk tolerance. And that's because when the market's down 25.8%, or we are, and the S&P's down 12, NASDAQ's down 22, GI, growth and income, is down 6.5, okay? It's designed to give a good return, but not the volatile return. Look at the 3-year return, okay? So we're at 15.7 in strategic growth, 5.5 in growth and income. But if you're happy with that and your money's liquid and you got a pro watching it, that may be right for you. So realize that's different than talking about how the programs are invested. Some programs are always going to be more aggressive than others. We have 4. We can talk to you about them if you'd like. All right, I'm going to get a drink here. If you guys have questions, now's the time. So I do want to mention, Alice sent out an email today, the reminder that you guys get, and said, send us a question. Well, we got one. And this is from a former classmate of mine who lives in my hometown. We appreciate you watching and sending us this question. Her question was, should I buy gold and silver? This is a question that's in the top 10 of all questions I've gotten for the 30 years I've done this. It's a very popular question on TV. The people hawking gold, including some newscasters that I really have respect for what they do, it just blows me away. You want to buy things that are going up, okay? And the theory is that when inflation goes crazy, that gold is going to be a hedge because it's physical, okay? Stocks are paper, cash is, fungible, but it's not, there's not backed by gold, right? So my response to that is look at the chart. So the top chart is gold for the last 2 years. Does that look like a chart of something you want to own? And then look at silver. That's definitely not something I want to own. So what they're not telling you in the TV commercials is how the underlying is actually performing. They're selling you on the concept of you can hold it. I see the ads, the guy takes it from the postman and I can hold this. It feels real to me. Well, go hold your house, okay? Grab a pillar on the house because my house feels real to me. Do I need to hold real gold? I do not. Based on this chart, is this something I want to own? It is not, okay? Let me look in the chat here. Hey, Nellie. Guys, no questions? This is your chance, huh? I'll give you one more at the end of the show, but I'm here to answer questions. World economy. GDP, we're still positive. Obviously, if we have a negative quarter, it'll turn to essentially the definition of a recession. You can see quarter 1, 22. We don't know what quarter 2 is going to be because we don't have the final read on that. The forecast is for it to be positive, and then the recession estimates are, you can see the 2 negative ones in 2023. They're guessing. They really don't know. If demand stays strong and the consumer continues to buy, remember 68% of our economy, there are only 3 components to GDP. I'd like to remind you this every once in a while. There's government spending, corporate spending, consumer spending. Well, that sounds like it should be like a third each. No, it's not that way. Fortunately, the government's only a single digit part of that, and I'd like it to be even less, but I digress. The consumer drives the American economy and indeed drives the world economy. So if consumers spend, you cannot have an increase in consumer spending quarter after quarter and have a recession. It cannot happen, okay? It just can't. I'm not doing much about Ukraine. We know it's a human tragedy. You can see the map continuing to get more red and more orange. That means Russia is moving in, and I just feel for these people so badly. But because it's a financial show, I do need to mention that they are, not in agreement, they are in conversations. Russia, Ukraine, Turkey, and the UN signed this agreement to allow grain shipments to continue across the Black Sea. I mean, you may not have known this, although if you've been watching my program since January and February and March, you would. Ukraine is an astounding producer of grain, soybeans, corn, all kinds of things, flaxseed. And that's all been endangered by this war. Of course, the human tragedy is more important than this, but this still, because it's a financial program, is important. So just know that freeing up this and coming to some sort of resolution will be important for the world markets as well. On the inflation front, yeah, you've seen it, highest consumer prices in 17 years. Okay, but do you see anything just crazy about that chart? Back to 1970, 1980, we were alive during then. Most of us still had 3 meals a day. Inflation calms down, it goes back up. Those are spikes, okay? You saw the spike down in 2020. You can see that on the chart. Spike way down in 2009. And then when things get strong again. We have a situation right now. It is really unusual. I've done this 30 years and, you think you've seen everything, but we have incredibly low unemployment. We have way more jobs than we have people to fill the jobs. And yet there's talk of this recession. It's really, really hard to have a recession when employers are just starving for employees. It just makes no sense at all, okay? And yet the small business confidence result here says that inflation's the biggest single concern. Your biggest single concern should be finding people to fill those jobs, Mr. and Mrs. Business Owner, okay? Let the inflation issue work itself out. The Fed blew it. There's a section on the Fed for those of you that are new. We'll get to that in just a second. But they're righting the ship, okay? They're getting it set. So inflation, yeah, and that's what the big news was yesterday. Rose 9.1%. And then today's PPI number also shocked to the upside, which is why the market tanked. But then you know what the strategy is now because you saw it earlier, okay? The NASDAQ was down 280 points and closed in the positive. How can that happen? It's not me going in and buying 1 lots in the NASDAQ futures or even 10 lots. It's Wall Street going in and buying billions of dollars of NASDAQ futures and buckets of stocks, okay? Because they know what's going on, all right? I'm not downplaying the news. I understand that there's a bunch of bad stuff out there. You have to take out food and energy. They are the most volatile elements. And so core PPI still was up 0.7 ahead of the estimate. But you just can't make the mistake of trading based on news or headlines because the market looks so far ahead. You saw the chart, right? Market goes down, discretionary is going up while the market's still going down. But the smart, big players on Wall Street are going in and buying those aggressive sectors. Okay, it's much more important to see how Wall Street reacts. This is a good piece of data. Now, I guess it's not a good piece of data if you're in the used car business, but look at the used car sales numbers plummeting. Now, normally I'd be bummed by this, but honestly, it's kind of good to see. And we're going to have our housing section, as we always do at the end. And it's good to see those numbers getting a little soft too. Now, I don't want my house to go, drop $100,000 or anything in value on Zillow. But hey, I'll chip in for the good here. Let's have our home prices just plateau. If that happens and the demand stays strong, then it's just going to be very difficult to drop into a recession. Part of the problem is with inflation is when there's so many people chasing scarce goods. And we have that with labor. We have that with consumer goods like homes, like cars, except that now that you see this data on the chart, you can say, this isn't a house, which is the most important consumer discretionary item, but it is cars, pretty big deal, and that's dropping. That means demand is leveling off or supply is catching up. Either way, it's good to reduce inflation. So you're going to, let me see, any questions here? A friend of my son works for GE Aircraft and Parts Division. Yeah, he's not allowed to even answer the phone if Russia calls. I wouldn't want to fly Aeroflight anytime soon. That's the truth, I tell you. And I'm guessing, Doc, that you're referring, I call Doc because we've known each other, 50 years. That he's probably referring to the Ukraine situation, but anybody from Russia that's calling, you want to be really careful picking up for sure. So recession, it's probably the number one term on Google other than, all the other things that you shouldn't be searching for on Google. And it's equaled, the talk of recession in 2020. So you see 2020 immediately came down. Why? Well, you know the answer now. How long was the recession in 2020? Anybody? 33 days. 33 days. It's almost a Mad Magazine article, Though we're not technically in a recession, at least I think we are, but it's not been announced, obviously, because we haven't 2 negative quarters of GDP yet. But this market pullback of 166 days is what makes this feel so bad. Could this drop on the other side and we'll see a little gray there when I'm doing the show for you in November? Yeah, I think so. We'll know. We'll know soon. So the probability keeps moving out. Again, this is how I'm sorry to be laughing, guys, but I don't know what to tell you. The news people, once the data gets to them that, you can't have a recession this year, well, then it's going to be 23. Well, maybe not. Maybe going to be 24. And then they're going around saying, what can we come up with to make it look like 25? There's always bad news up ahead. All right? Because they need to give you a reason to come back and watch the show. All right? It's up to you whether you come back and watch my show. I'm just telling you the truth. All right? I'm telling you the truth of how I manage money. I'm telling you the truth of the data that I see and the incredible expert team that I have that works with me to figure out how to best manage your money. Okay? So the chances of entering a recession, 20%, 10% in 24, no recession by the end of 2024. That's actually the biggest number, 30%. So this is updated probably every month. Honestly, I put it in here just so you can see how dorky it is. Why are we predicting this? Let's go out and make widgets. Let's, get better jobs. Let's do things. Let's just live and quit trying to predict the next Chicken Little. All right. But there are people that get paid to do this, believe it or not. The employment scenario, so you guys know we do this show on the second Thursday because the first Friday is when the monthly employment data comes out. So the U3 unemployment rate flat, okay? But it's well below 4%. I mean, look how it spiked there, 14.5%, actually almost 15% during the pandemic's height there in 2020. And it has just dropped dramatically since then. You cannot have a recession with the unemployment rate at 3.6%, or at least it's never been done. I don't even know what it would look like. I mean, there's nobody on the street begging like it was in the Great Depression, because if people did that, the employers would be out there rounding them up and sending limos to get them to work in their companies. All right. That's the situation we have. So in the non-farm payroll that just was issued last Friday, where are the jobs? Education, health services, business services, leisure and hospitality is now coming back in full force. Have you tried to fly? Have you tried to rent a car at an airport? I've told the story. Oh gosh, when we went to Chicago, my wife and I, we had the last Alice and I, we're renting a car, right? And our plane was late. And so they said, it's kind of thin. And we went out, there was two cars. And so one couple started running and got to the other car, and we looked at this other couple and we both started running to the car. Okay. And that's because all these rental car companies sold their inventory during the pandemic, and now they're bringing it back. So this is why you're seeing leisure and hospitality coming back, transportation, warehousing. There are areas of the economy that are getting replenished since the great downturn of the pandemic. Okay. What you're not seeing is government. And I like that. Let's don't bring back and increase the size of government, whether at the federal, state, or local level. Okay. All right. So expectations of higher employment, that's turned back up. I think that is, again, as long as not only employment, but the expectation in the data for higher employment is strong, really tough to have a recession, which is why 3 slides ago, they're pushing that data out into the future because they see the same thing that I see. Okay. Non-farm payrolls has now exceeded pre-COVID peak in 2020. Look at that. It took us 2.5 years, not quite, 2 1/3 years, and we've now exceeded it. That is a V-shaped recovery. Okay. The most mentioned thing that I've said in this program is recency bias. Okay. But the second most is V-shape. And that means like, whoa, the market comes down and whoa, oops, that was wrong. Never mind. Like Gilda Radner used to say. And that's what happened here in so many areas of the U.S. economy. Not so overseas. We recovered much more quickly than the overseas markets did. Asia, Europe, that's a story for another time. But look at this data. We are now back to where we were pre-COVID payrolls, okay? All right, the political section here. Missing anything? I still don't have any questions. Okay, so I have heard from a few of you that maybe I have been a little too opinionated about the current administration. So I have decided I'm not going to say anything in this particular show. And what I'm going to do is turn to the premiere of Alberta, Canada, for his assessment on what's happening here in America.
You know, we had President Biden vetoed the Keystone XL pipeline, which would have safely delivered 840,000 barrels a day of responsibly produced Alberta energy to U.S. markets. He vetoed that in January, and now he is begging and pleading with the OPEC dictatorships and Putin's Russia to increase production and shipments to the United States. He's pleading with developed countries to open their strategic petroleum reserves. He's lifted sanctions on Russia, building their gas pipeline to Western Europe to dominate strategically Western European energy interests. He's lifting sanctions on American investment in offshore Venezuelan heavy oil development. You know, President Biden, we Albertans have a message for you. If you don't have enough oil, we Albertans are happy to help out. Approve the Keystone XL pipeline. It's not complicated. And by the way, did you know the Keystone XL pipeline, it was going to deliver 840,000 barrels a day of energy produced at the world's highest environmental, human rights, and labor standards? But today, the United States is importing 840,000 barrels of dirty conflict oil from Putin's Russia. It doesn't make any sense, but we won't relent. We will continue to fight for common sense in global energy markets.
Well, I couldn't have said it any better myself. So I'm hopeful that this administration will realize that we were energy independent in the previous administration, and we need to go back to those policies. So we don't need OPEC, and we don't need Russian oil. We don't need Venezuelan oil. I'm happy to buy it from Canada. That's great. He was certainly in support of his own country there, but just my 2 cents. I thought that you would want to see that it's not just me that has less than flowing and glowing opinions about how this administration has handled some things. So we got this from one of our viewers. I don't know how much of this you can see, but if you want, I'll send this to you. This is just, what does it take to be wealthy in America? So at the top of the graph there, you can see 122,000 is the average net worth of the average American. Now, you are considered wealthy in the state of Mississippi with 766,000. And then you can follow the graph. If you can't see it, again, I'll be happy to send it to you. But wealth is relative. I can tell you that our dollars are going a lot further here in Tennessee than they did in Illinois for a third of a century. And we like it here. So this is just a really interesting perspective on what it takes, or what the perception is of being wealthy. Okay. And if you want me to send it to you, I'm happy to do it to you. So consumer spending, again, this is the economic data section. We're still seeing increases in services and in the total amount of consumer spending. We are seeing a drop off in durable goods, all right, and non-durable goods. That's the blue line. So that's discretionary items that are larger ticket, washers and dryers, even cars. Again, you saw the used car number drop. But in general, the American consumer continues strong. When they get on the bandwagon, send them the link for this video. I think they'll go back to their ways, and that's why I believe the market will be at new highs in January. It will be driven by consumer spending. All right, the Fed, send chart of wealthy in America. Yes, I will do that. Yay, Alberta, says Martha. Thanks, guys. And Caron, yeah, facts are facts, no matter whether I say them or the Premier of Alberta, Canada, says them. So here are the players. Jay Powell, that's Loretta Mester, who is the hawkish member, of one of the most hawkish members of the Federal Reserve presidents. There are 12 of them. And then Christine Lagarde, who's the chairman of the European Central Bank. And they are trying to find a way across the world to wrestle with this inflation issue. So probably because of the jobs report last week and the two CPI and PPI, 75 basis points this month is a rock solid certainty. And actually, there are some people calling for 100 basis points. I'm not concerned about that because, again, Wall Street has been expecting that. They can extrapolate when they see things happening. what the Fed's going to need to do. They are 3 to 5 moves ahead. Remember the visual up front. Okay? They're smart people. So the target rate for Fed funds, again, the lower this is, the lower the cost of money is for businesses, the lower cost it is for mortgages. I mean, we just happened to be at a time here when we got a mortgage on our house because the rates were so low I couldn't justify paying cash. We paid 2 5/8, 6.25, right? For those of you that like decimals. And now you're seeing 6%, for not so great quality, 7%. And that's going to continue to rise as the Fed fund target rate, because the Fed fund sets the benchmark, if you will, for all the interest rates. Even though technically the Fed doesn't regulate and can't control high-end interest rates, they certainly follow it and they are informed, they meaning banks and mortgage companies are informed by the Fed funds rate. All right. Oh, did I miss Charles Todd? Question. CB3, what are your thoughts on the IMF warns of global debt crisis, which is a liquidity crisis? Thank you for that, Nellie, and thank you, Charles, for the question. So, International Monetary Fund concerned about global debt. Well, debt is an issue across all borders. I mean, we now have more debt than we have GDP for the first time in my lifetime during this administration. It didn't get any better during Trump's administration, by the way. Liquidity is not, I don't agree with them on this because banks are going to continue, the Federal Reserve and other government treasuries are going to generate as much cash as they need to do to continue to pay their bills. That, of course, is what fuels inflation. I think that the International Monetary Fund is a political entity. They are looking out for their best interests, which is not necessarily in sync with American interests. So I don't know that we're ever going to see spending controlled in our lifetimes because it is such an unfavorable political position. Nobody's going to get elected saying, I'm going to drop the debt from 30 trillion, 33 trillion to 15 trillion in 4 years. It could be done. And by the way, you might as well get used to ramen noodles, because it would definitely put a big burden on the American and the world consuming population. So that's my take on what they said. So anyway, thanks. I'm glad I didn't miss that. If I missed anything else, guys, mention it in the chat. I'll try to get better about looking down there. So stocks do tend to do just fine during Fed hiking. So when you see 75 basis points, which is a lot, and then you see maybe 100 basis points, this is looking back to 1946. Look across here. Here's the hike. Here's the rate. Total number of hikes. What was the return during the cycle? It's almost all green, not totally. 1972, it wasn't. 67, it wasn't. 1987, which of course was the Black Monday market crash. But most of the time, this is the hard data. You will never see this chart on CNBC, okay? Or The View or anything else. You're just going to hear about how terrible it's going to be when the Fed raises interest rates. I would prefer interest rates to be at 0.25% all the time, but not with inflation at 9%, because I can live with a Fed funds rate at 4, 4.5, 5. I don't want to see it at 8 to keep inflation in check. But this is the history, okay, from Bloomberg, and they've got it from the Treasury Department on what it has been for performance during previous hikes. So in housing, we're still seeing tons of construction spending. Look at that black line. What you're not seeing is non-residential, and that's the blue line. For 2.5 years since I've been doing this program, I've told you that I believe work from home is here to stay. And I know for a fact that there are even people very close to me that make a decision on whether to take a job with 3 offers. 3 offers. Okay? Which one had the best work from home policy? And that's why you're not seeing non-residential building going up much at all. But residential, absolutely. And they're doing this in spite of increasing mortgage payments. Look at this mortgage payment just skyrocketed, and that's strictly because of interest rates. All right, I feel really blessed to have a 2 5/8. It'd make it really tough to ever leave here. So, it's just a great rate. And it will come back down to that range. I don't know if it'll be 2 5/8, but 3.5, 4. It's not there now. All right, but people are still buying. So 6% of listings have had price drops. I wasn't saying this on the program for the last 2.5 years. And in fact, I've only said it the last 2 shows, I think. So even in April, we were still pretty strong. Okay. We are seeing some price drops, but again, I'll chip in. I'll give one to the team here, and let's have some little bit of downturn in prices to get more people coming back into the market and maybe get more people to list their homes because they're panicking. Oh gosh, prices are starting to drop. If I don't put my house up for sale, I'm going to end up just giving it away. So, all right. Buyer demand index still real strong here. That's the blue line. Not seeing an issue with that either, guys. And every recession has been preceded by weak housing. So you see those spikes there, 2010, 1980. Do you see a spike where we are right now? I'm giving you good housing data. It's not the best it's been, but it's really, really good. It's a 91 out of like 103%. Just crazy, for the last year and a half, and it's cooled off a little bit. But you got to see that number move back up to where it was in 2008 and 9. Look at those red arrows. Okay. All right. So I think we're in good shape. Let me pause and see if we got any more questions that I missed. I got Charles Todd's. I hope that answered it, Charles. Anybody else? Any questions? I'm going to grab a quick sip here. You like my new fancy graphic here for questions? I thought maybe that would inspire you to ask something. So, okay. Do you think there will be a global economic meltdown of untold proportions that is being called for? Not a chance. Okay? I just don't see it, Charles. Again, what does that mean and who's predicting it and on what data are they predicting it? I'm showing the actual data that's, the market is driven, the stock market, which is the most front-leading indicator of consumer sentiment because it's where people spend their money. I'm showing continued earnings, and earnings are rising, and interest rates, while rising a little bit, are still not in any kind of dangerous area. Those of us that are roughly my age remember 1980 when you could get a CD for 13.5%, but that's because mortgages were 16%. All right. I don't see it. And I'm not investing for that. And Wall Street is not investing for that. All right. Because if they thought that there was going to be a serious downturn, they have billions, maybe trillions of dollars of client money. And they wouldn't be putting that money at risk. They're putting money at risk by moving from value sectors, value space to growth, from utilities to consumer discretionary, all in the charts that I've shown you tonight. Okay. Real estate prices drop as interest rate goes higher. Yep. When I bought my house, the interest rate was 13, but the house price was relatively low. There you go. And I hope now you've got a really great Zillow estimate on your house, Doc. So I think that I should tell you guys that, because I'm giving you a little bit more time to send in questions if you have them, that when I was 14, I ran into a telephone pole catching a pass in a neighborhood football game, and I knocked my front tooth. And so 3 different dentists have been patching it back together for the last 52 years. And I bit into an apple a couple weeks ago, and it came out. So if you've been noticing that I don't have a front tooth, I have an implant is taking 6 weeks to grow in place there. And I'm hopeful by the next show that I will have a proper front tooth there. I hope it hasn't looked too, as my dentist, my surgeon said, well, now you look like you're from Tennessee. So if there are Tennesseans watching, please forgive me. Those are his words. And he lives here. He was born and raised here, not me. So, all right. Well, I don't see any more questions, guys, but this is the show. Tell your friends, have them come back and watch. These are the topics we cover every week. The next show will be Thursday, August 11th, and we'll still be on Central Daylight Time, so it should be the same. Just a reminder to subscribe to us on YouTube, click the bell, and watch for me on YouTube every day, Facebook, and Twitter, okay? Always in the show with this. We've not been given a spirit of fear, and that's part of the reason that enables me to believe that the best is still ahead, Charles. But a spirit of power, love, and of sound mind. It's easy for me to have a sound mind when I believe the faith that I do, but also when I see the data that I do, because the data supports good decision making. I don't watch the news, and what I do is I look at the data, and that's how I manage our money. And that's how I take care of you guys that are clients. And for those of you that are here just to get educated, that's how I take care of you, because the goal is 1 hour later, I'm hopeful that you are more peaceful about your financial future. I think I've got all nice comments in the chat, but no questions. If you change your mind and have a question for me, cb3@cb3.com. Wishing you guys all the best at CB3 Financial Group. We don't just manage your assets, we become one of them. Hope you guys have a great night. Enjoy your summer, and we'll see you next month.